stock market, as you imagine it, does not exist. The image deeply ingrained in the public consciousness of a bustling floor on Wall Street filled with shouting men in colored jackets waving paper tickets and frantically signaling orders is a historical reenactment. It is theater maintained for the television cameras and the comfort of the public. The real market is a silent, freezing room in a data center in New Jersey, filled with rows of blinking server racks, connected by fiber optic cables carrying data at the speed of light. And in that room, humans are not invited. For the past 2 decades, a quiet but absolute revolution has taken place in the financial world. It was not televised. It was not debated in Congress. It was an engineering coup that fundamentally altered the DNA of the global economy. The human trader, with his intuition, his fear, his greed, and his capacity for moral judgment, was deemed inefficient. He was too slow. He needed sleep. He took lunch breaks. He hesitated in the face of danger, so he was replaced by code. Today, it is estimated that over 80% of daily trading volume in U.S. equities is not executed by humans, but by machines. High-frequency trading algorithms, quantitative models, and passive index bots now dominate the financial landscape. They trade in microseconds, battling each other for fractions of a penny, thousands of times a second. This transition was sold to the public under the banner of liquidity and efficiency. We were told that computers would make markets tighter, spreads lower, and trading cheaper for the average investor. And on the surface, this is true. Buying a stock is now free on most platforms, and execution is instant. But this convenience came at a hidden cost, the creation of a ghost market. What is a ghost market? It is a market where the activity you see on the screen is largely an illusion. When you look at a stock ticker showing millions of shares trading hands, you assume it represents thousands of individual investors making rational decisions based on news, earnings, and economic data. It doesn't. Most of that volume is what market microstructure researchers call noise trading or ghost liquidity. It is bots trading with other bots, often washing the same shares back and forth to create the appearance of activity. They place massive limit orders on the books to signal intent, only to cancel them microseconds before they are executed. This is called spoofing, and while technically illegal, it is practically impossible to regulate at the speed it occurs. The result is a market that looks incredibly deep and liquid on a calm day. You can buy or sell any amount of Apple or Tesla stock you want without moving the price. But this liquidity is a mirage. It is only there when it is not needed. The moment true volatility enters the market, the moment a real crisis hits, the bots are programmed to do one thing: unplug. They pull their bids. They cancel their orders. The liquidity evaporates instantly. This is what happened during the flash crash of May 2010, when the Dow Jones Industrial Average plunged nearly 1,000 points in minutes, wiped out over $1 trillion in market value, and then recovered just as quickly. Regulators blamed a single large sell order from a mutual fund for triggering the event. But the real culprit was the market structure itself. The high-frequency trading firms, which had been providing the illusion of liquidity, saw the selling pressure and simply turned their machines off to protect their own capital. The human market makers of the past, who had a legal and moral obligation to maintain an orderly market during a panic, were gone. The 2010 flash crash was a warning shot. It was a small preview of what happens when the new machines are left in charge. Since then, the market has become exponentially more automated, more interconnected, and faster. We are no longer just dealing with simple algorithms that follow rules. We are dealing with complex AI and machine learning models that evolve, learn, and react in ways even their creators do not fully understand. We have built a global financial system on a foundation of sand, and the tide is coming in. The danger lies in the decoupling of price from value. In a human market, price discovery is a negotiation between buyers and sellers who have different views on the value of an asset. One thinks the company is undervalued, the other thinks it is overvalued. They meet in the middle. In the ghost market, price discovery is a game of tag between algorithms trying to predict the next micro movement of other algorithms. They are not looking at the balance sheet of the company. They are not looking at the quality of the management team. They are looking at the order flow. They are looking at momentum. They are looking at mathematical correlations that have nothing to do with the real world. This creates a fragility that is hard to overstate. When prices are determined by the herd behavior of machines rather than human judgment, prices can deviate wildly from reality and stay there for a long time, until they don't. The Great Reset narrative fits perfectly into this environment. If the elites know that the financial system is a hollowed-out, bot-driven bubble waiting to burst, they need a plan for when it does. A massive, uncontrollable AI flash crash provides the perfect cover story for a systemic reset. It wouldn't be blamed on bad monetary policy or excessive debt. It would be blamed on a technological glitch or a cyber event. The complexity of the AI models would be used as a shield. Nobody could have predicted how these complex systems would interact, they will say. This shift has also fundamentally changed the nature of ownership. When you buy a stock today, you're essentially buying a digital token in a casino run by robots. The connection between the shareholder and the company has been severed by layers of intermediation and automation. You are not an owner, you are a passenger on a high-speed train with no conductor, hurtling down a track built by algorithms that prioritize speed over safety. And as we approach 2026, the tracks are running out. If the first phase of automation was about speed, doing what humans did, just faster, the current phase is about intelligence, or perhaps more accurately, the illusion of intelligence. The new generation of trading algorithms are powered by artificial intelligence and deep learning. They don't just execute trades, they read the news, they analyze social media sentiment, they parse central bank statements, and they identify complex patterns across thousands of asset classes simultaneously. On the surface, this sounds like a recipe for a smarter market, but in reality, it is creating a dangerous homogenization of thought. In the past, you had millions of human traders with different backgrounds, different risk tolerances, and different time horizons. Some were value investors looking at fundamentals. Some were chartists looking at technicals. Some were contrarians who bought when everyone else was selling. This diversity of opinion is what creates a healthy, robust market. It ensures that there is always someone on the other side of a trade. If everyone wants to sell, the value investor steps in to buy because the price has dropped low enough to be attractive. This creates a floor. Today, the dominant players are large institutional investors, hedge funds, pension funds, sovereign wealth funds, all using similar data sets and similar AI models to make their decisions. These models are often trained on the same historical data, use the same risk parameters, such as value at risk models, and react to the same inputs. This creates a monoculture in finance. It is like a vast agricultural field planted with a single genetic clone of a crop. It is highly efficient, but if a disease comes along that targets that specific clone, the entire field dies instantly. In the financial markets, this monoculture means that when a specific trigger event occurs, all the AI models tend to reach the same conclusion at the exact same time. They don't debate, they don't hesitate, they act. Imagine a scenario in 2026. Inflation ticks up unexpectedly. A geopolitical crisis erupts in the Middle East. A major tech company misses earnings. In the old world, human traders would digest this news differently. Some would panic sell, some would see a buying opportunity. The market would be volatile, but there would be two-way action. In the ghost market, the AI models instantly process these inputs. Their algorithms, trained on decades of data showing that this specific combination of events leads to a downturn, all trigger a sell signal simultaneously. Suddenly, you have trillions of dollars of selling pressure hitting the market in a single millisecond. Who is on the buy side? Nobody. The other bots are selling too. The retail investor is asleep or at work. The human market makers are extinct. The result is a liquidity vacuum. The price has to drop vertically to find buyers. In a matter of seconds, the S&P 500 could drop 20 or 30%. Stop-loss orders on retail 401ks would be triggered automatically, adding fuel to the fire. Margin calls would go out to leveraged hedge funds, forcing them to liquidate other assets, spreading the contagion across the globe. This isn't a theoretical possibility. We see many versions of this happen constantly in individual stocks that suddenly drop 40% on no news, only to recover later. We saw it in the Volmageddon crash of 2018, where products linked to market volatility imploded overnight due to algorithmic feedback loops. There is a concept in internet culture called the dead internet theory. It suggests that the majority of the internet is no longer populated by real humans. Instead, it is a vast ocean of bots talking to other bots, generating fake content, fake comments, and fake engagement to game algorithms and generate ad revenue. The theory posits that the internet feels hollow, repetitive, and disconnected from reality because it is, in essence, a simulation running on autopilot. The financial markets have become the ultimate manifestation of the dead internet theory. The stock market is no longer a reflection of the real economy. It has become a closed-loop simulation, a video game played by supercomputers for high scores measured in dollars. Think about the disconnect. We have seen record-high stock prices coincident with high inflation, falling real wages, supply chain crises, and geopolitical instability. Why? Because the machines are not looking at Main Street. They are looking at the Federal Reserve's liquidity injections. They are looking at corporate stock buybacks. They are looking at technical momentum indicators. The market has become a Keynesian beauty contest on steroids. John Maynard Keynes famously compared professional investment to a newspaper competition where participants have to pick the 6 prettiest faces from 100 photographs, with the prize going to the person whose choice most nearly corresponds to the average preferences of the competitors as a whole. To win, you don't pick the faces you find prettiest. You don't even pick the faces you think the average person will find prettiest. You try to anticipate what the average opinion expects the average opinion to be. In the age of AI trading, this has reached its logical extreme. The AI is not trying to determine the intrinsic value of a company. It is trying to predict what other AIs will do in the next millisecond. It is algorithms trying to game other algorithms in an infinite regress of prediction. This detachment from fundamental reality creates a systemic fragility. The machines are optimizing for the present moment, for the next tick, not for the next decade. They are maximizing short-term efficiency at the cost of long-term resilience. And because they control the vast majority of the capital, they drag the rest of the world along with them. We are living in a financial system that is hallucinating its own prosperity, driven by code that cannot understand the human consequences of its actions. When the hallucination breaks, the awakening will be brutal. The danger is further amplified by the rise of passive investing. Trillions of dollars are now blindly invested in index funds like the S&P 500. These funds don't make decisions. They just buy whatever is in the index. When money flows into these funds, they must buy all 500 stocks, regardless of valuation. This has inflated a massive bubble, driven by automated flows rather than fundamental analysis. It is the fuel that has powered the market's rise, but it is also the explosives packed into the foundation. Consider the mechanics of an ETF, or exchange-traded fund. It promises you instant liquidity. It promises that you can sell your shares at any moment during the trading day. But the underlying assets, the actual stocks and bonds inside the fund, are not always that liquid. In a calm market, this mismatch doesn't matter. The authorized participants, the big banks that manage the ETF mechanism, smooth out the differences. But in a crash, the mechanism breaks. We are heading toward a scenario in 2026 where the baby boomer generation, which holds the vast majority of the wealth in the stock market, begins to sell en masse. They are reaching the age of mandatory withdrawals. They need cash to pay for retirement homes and medical care. They are moving from being net buyers of stocks to net sellers. At the same time, the AI algorithms detect a shift in the macroeconomic winds. Perhaps it is a debt crisis, or a new war, or simply a loss of faith in the currency. The AI triggers a sell-off. The boomers see their portfolios drop and panic. They call their brokers or log into their accounts to sell. This triggers a massive outflow from the passive index funds. Here's the nightmare scenario. The passive funds become forced sellers. To meet the redemptions, they have to dump all 500 stocks in the index into a falling market. They don't care about price. They are mandated to sell. This creates a vicious, self-reinforcing downward spiral. The selling lowers the prices, which triggers more AI sell signals, which triggers more panic among retirees, which causes more redemptions from the funds. Who catches the falling knife? In the old days, value investors would step in. But remember, the human trader is extinct. The value investors have been crushed by a decade of irrational markets. They don't have the capital to stop the slide. The ghost market reveals its true nature. It is a crowded theater with a very small exit door. When everyone tries to leave at once, the exit gets clogged. The ghost liquidity vanishes. The bid-ask spreads, the difference between what buyers want to pay and sellers want to accept, widen to canyons. You might see a stock trading at $100 and the next trade is at $70. The continuity of the market shatters. This is the super flash crash. It won't last for minutes like in 2010. It could last for days or weeks. Trillions of dollars of paper wealth, wealth that people were counting on for their survival, will be erased. It is the great liquidation executed at the speed of light. And this is where the dead internet theory applies to your life savings. You thought those numbers on the screen were real. You thought they represented factories, patents, land, and inventory. But they didn't. They represented a multiplier applied by a robot to a flow of funds. When the flow stops, the multiplier goes to zero. The psychological impact of this event will be shattering. For decades, the public has been told that the stock market is the only way to build wealth. They have been told that stocks always go up in the long run. They have been herded into 401ks and IRAs, effectively trapping their capital in the casino. A collapse of this magnitude breaks the social contract. It exposes the financial system for what it has become, a mechanism for wealth extraction disguised as a vehicle for wealth creation. The regulators know this risk exists. The Securities and Exchange Commission, the Federal Reserve, the Bank for International Settlements, they have all published papers warning about the dangers of algorithmic trading and ETF liquidity mismatches. They know the structure is unsound, but they cannot fix it without popping the bubble they helped create. To ban high-frequency trading or restrict passive flows would cause the very crash they are trying to avoid. So they pray. They hope the machines keep dancing. They hope the music doesn't stop on their watch. But the math is relentless. Exponential systems cannot grow forever. Leverage cannot be infinite. The algorithms are programmed to maximize profit, but they are also programmed to survive. When the survival of the algorithm requires the destruction of your portfolio, the algorithm will not hesitate. It does not have empathy. It does not care about your retirement. It only cares about its code, and the code says, sell. If you understand that the market you see on your screen is a simulation, a ghost market run by machines that will abandon you in a crisis, then you must fundamentally change how you approach your financial survival. The realization that the game is rigged is not a reason to despair. It is a signal to adapt. The strategy that worked for the last 40 years, buy, hold, and pray, is the strategy that will lead to ruin in the algorithmic apocalypse. The first rule of survival in a ghost market is, do not play their game. If you are a retail investor trying to day trade against high-frequency trading firms and AI hedge funds, you are bringing a plastic knife to a thermonuclear war. You cannot beat them on speed. You cannot beat them on data processing. You cannot beat them on execution. The game is rigged against you. The short-term movements of the market are noise generated by bots to separate you from your money. Every time you trade, you are feeding the sharks. The second rule is, understand the difference between price and value. In a ghost market, price is what a bot is willing to pay right now based on its programming and the available liquidity. Value is the real-world utility and scarcity of an asset. In a flash crash, prices will collapse, but value may remain unchanged. A productive piece of farmland is valuable regardless of what the stock market ticker says. A gold coin is valuable regardless of what an algorithm calculates. A profitable local business that serves a real community has value that cannot be erased by a line of code in New Jersey. You must shift your focus from accumulating paper wealth, stocks, bonds, digital numbers on a screen, to accumulating real wealth. Real wealth is tangible. It is outside the financial system. It is things you can touch, hold, and use. This is the only hedge against a system where the counterparty is a machine that can go offline. Precious metals, specifically gold and silver, are the historical hedge against financial chaos. They have no counterparty risk. When the digital systems crash, when the power grid flickers, when the internet is locked down, physical metal is the ultimate form of payment and store of value. It is the only asset that is not someone else's liability. In a liquidation event, gold is the one thing that bids no bid. It is the ultimate collateral. Land and real estate are also critical, but with a caveat. You must own it outright or have a fixed, manageable debt. In a crash, commercial real estate and leveraged residential portfolios will be wiped out. But a paid-off home with a garden, a well, and a solar system is a fortress. It provides the basic necessities of life, shelter, water, energy, independent of the ghost market's fluctuations. The third rule is, definancialize your life. The more your existence depends on the smooth functioning of the global financial machine, the more vulnerable you are. If you need to sell stocks to buy groceries, you are in danger. If you need a functioning credit card network to put gas in your car, you are in danger. Reduce debt, build emergency reserves in cash and physical assets, build strong local community ties. In a systemic crisis, your neighbors are more important than your brokerage account. The skills you have, your ability to fix, to grow, to build, to heal, are assets that cannot be hacked or devalued by inflation. The aftermath of the crash will likely bring about the solution the elites have been preparing for: central bank digital currencies, CBDCs. In the chaos of the crash, when paper assets are burning and banks are failing, the government will offer a safe digital account directly with the Fed. They will promise stability. They will promise to restore your lost buying power, but with conditions. This is the trap. The crash of the fake market will be used to justify the end of the free market and the imposition of a fully controlled, programmable currency. By holding real assets outside the system, you give yourself the power to say no. You preserve your agency. You position yourself not as a victim of the simulation, but as a survivor in the real world that remains when the plug is pulled. The ghost market is a magnificent illusion. It has made a few people incredibly rich and lulled the rest of the world into a false sense of security. It has allowed us to ignore the rotting foundations of our economy because the stock market line keeps going up. But illusions always shatter eventually. The machines are programmed to save themselves, not you. When the AI consensus shifts, when the liquidity vanishes, and the prices freefall, don't be the one staring in disbelief at a frozen screen. Be the one who recognized the ghost in the machine and prepared for the inevitable exorcism. The crash is coming. It is a mathematical certainty born of leverage, automation, and hubris. The only question is whether you will be ready. I'm Tom, and this is The Wealth Collapse. Subscribe now to stay ahead of the curve, because when the history books are written, you'll want to be one of the few who saw it coming.